right, welcome back to 0.5%. This is episode 15, part 2 of the weekend research. The research did proceed over the weekend, but it's now Monday, April 14th. It just got late and I learned a lot. I didn't think I was able to process it yet. I've actually made this video one time over already, trying to process it again. So I think this is a good point to start in for the third time now. But what I want to jump into is gold. So I've been trading these portfolios called NUGT and DUST, which DUST is the inverse of NUGT. They're both 2 times leveraged portfolios of the Direction Gold Miners mutual fund, or I believe that's what it's called. And then for the majority of the holdings in these companies, it's either that or the US dollar. Through my research, I've also found a smaller version of NUGT, I guess to put it simply, in regards to assets under management. And there's actually a slight reversal too on the percentage of holdings. There's a portfolio called JNUG, which is essentially the junior version of NUGT. It has about half the amount, or no, like even less. It has about a third of the amount of volume daily going through it. I think half approximately of the assets under management, and it holds more of the US dollar than it does actually the Direction mutual fund. And there's a slight difference too with the mutual funds that it's actually holding. I believe because this is leveraged, there is a junior non-leveraged that this is technically following, if I understand it right. And NUGT is the same way. So if you look at where these are listed, let's see if I can find it under right here. So this on Direction's daily gold miners index bull 2 times, that's NUGT. The index tracked is the New York Stock Exchange ARCA Gold Miners 200%. And then this junior one that I found is MVIS Global Junior Gold Miners 200%. So I think for both of these, there is an equivalent ETF that isn't leveraged 2 times. And when I brought up this video, I wanted to see the comparison between these mining ETFs to gold itself. And I'm going to pull up gold here in a minute, but I learned a significant amount just by looking into NUGT, JNUG, DUST on, and there's a JDST, which is the junior DUST, on FinViz and ETF database. So what we're looking at right now is ETF database. The tab that I was just on was this performance tab. So I want to pull up the performance tab and compare the junior portfolio to the entire NUGT portfolio. And you'll see, so 1 month return, we have a 24% to 21 junior lagging. 3 month, 63 to 54. Year to date, 82 to 72. So in general, NUGT's been outperforming the junior portfolio. And I'm trying to think of how this makes sense and how it could be advantageous to somebody. And what I've concluded so far is more of the holdings in JNUG, the junior version of NUGT, are with the dollar, rather the gold miner Direction portfolio or mutual fund. And to me, that just means it might be a little bit more stable. I mean, gold's already pretty stable. The US dollar is already pretty stable. But I think relative to each other, gold is more volatile than the US dollar. I don't know if that's true, but that's my initial thought process on this. So not only are they holding less, they've got more invested in the dollar. There's still some pretty significant returns. I mean, like 21% in just a month. It's pretty nice. Second one that I want to pull up though was DUST, just to do a comparison of performance. So let me pull up Dust and I'll keep those side by side. Let's go down to performance, just like we have open for Nugget. And look at that. So Dust, negative 37 on the 1 month, 51 on the 3, 57 year to date. And that shouldn't be surprising. Even though there's days that I'm trading Dust, it's way up. It's just because Nugget is down. Those will keep going up. As the inverse, like most inverse of anything in the stock market, SQQQ or SOX S, whatever, those inverse portfolios are made to go to zero. Like as long as the company is still in business and they become more and more profitable, the inverse will become less and less. So that's what I would expect. It's kind of interesting though, just to see the actual returns side by side in comparison. This ties in a little bit to what I said in a previous episode about how negative returns are like 50% more than positive returns if you're buying in at the price that you lost in the negative return. So I want to pull up the charts. I've got Nugget here on Finviz, and I've got JNUG here on Finviz. Can see in the recent days of trading, they're in a very similar shape and everything. That's kind of what you would expect. It's tracking the same portfolio, just with less, right? But I can point out a couple differences here. So for example, we have this triple top that it looks like on JNUG. It draws the line from here over to more recent times. But the triple top on Nugget, it doesn't touch way out there. I don't know if there's some super long stem I can't see, but this is a small difference. And then check out the volatility in this upward channel. So on Nugget, it came a lot closer to the top of that channel than it did in JNUG. So like we have the similar shapes, we've still got the same moving averages over each other. We have same upward channels, same resistance and supports. Let's see if I scroll over a bit more, if we can see some of these last candlesticks. So even on the candlestick, for example, we've got more wick on the last day with Nugget than we do JDST or JNUG. So let me think about with that. So Nugget ripped more and then pulled back a little bit, where maybe there was a delay with the junior portfolio because there was less volume. So as the bigger portfolio figured out where it was going to sit, the smaller one had less wick. It's probably some there. You can just barely see it because it's settled right where it was supposed to be. If I scroll down a little bit, we can see from Finviz they have some information about the volatility, which is pretty interesting. And if I put my cursor over it, you'll see that it's referring to the volatility of the week and the month. Nugget's volatility, respectively, has been 9.3 and 7.2, whereas JNUG has been 10.1 and 7.8. So as of right now, there's been more volatility on the junior portfolio. However, let's look at the price change. We have 1% on Nugget and 3% change on JNUG. That's the current volatility, the current change. And with the 3% over one lead, I would want to be in JNUG. But coincidentally, I just made this video like 30 minutes ago and deleted it because I didn't like the way I was talking. And this was reversed. The volatility was higher on Nugget, and now it's higher on JNUG. So I don't want to make a conclusion about this part yet. It seems, yeah, there's more questions to be asked here. You can see on the volume, we have 1.7 million, whereas over here we've got just 500,000. So I think those swings with less volume, if the price is expected to change, they're going to be more rapid. Maybe slower to happen, but more rapid when they do. I'm not sure. But I from finding this junior portfolio, it was kind of an interesting little bonus to add into the gold topic of the day. I still want to stay in Nugget, but it did bring up an interesting point that I think I can benefit from. There's a whole bunch of these alternative ETFs in this sector, or leveraged equities, whatever you want to call it, that also have inverses. You can do this with gold, you can do this with oil, you can do this with some of the larger indexes like QQQ and SQQQ. So yeah, I think if you find comfort, or if I find comfort continuing to trade these, now I've widened my horizon of which ETFs or listings can perform this type of way. So what I want to jump into next, we're getting close to the end of the episode, is gold. Let's just take a look. So I'm on Yahoo looking at gold on 1 month candlesticks. Each one of these candlesticks represents a month. So you'll see on the x-axis here, we're going all the way back to 2010. We got 15 years in front of us. And there's a dip within the last 15 years, but then quick recovery and an even further run up, a slight breather in between those. I haven't been looking at this long enough, but I would say for myself, I've got some gold. I might go sell it. Like this, or at least like on a huge scale, is looking good. It's way at the top of the Bollinger Band. I mean, like at bare minimum, it could go sideways until it gets to its blue, and I got out at a good price at an earlier time. Or it could come down to the blue and then bounce back up, and I could go buy maybe some more gold. But I have a feeling the stock market's going to come back sooner than that. When the stock market starts ripping, gold will probably chill out. But something to keep in mind for perspective too, like, so look how important these moving averages are here. This crossover there signaled what was not only a downtrend, but then just a crab walk for years. Like, if you got out here, or if you didn't get out here and you saw this drop and you were waiting for it to come back, that's, oh God, like, that's 7 years. You would have been just waiting. So these crossovers are pretty significant. This one was really, look at the moving averages. They're really close to each other though. I feel like the price from where it's at here could significantly come down before they even cross and give that signal. Like, look how overbought it is on RSI. If we look at the peak of RSI here, it was time to get out, and it gave you 2 days of opportunity here. Right now, we've had 3 days of opportunity to sell your gold. And I mean, when it was overbought in the past, 2005, 2008, that RSI dipped a little bit to bring it back just to closer moving averages, 10 and 20, and kept ripping. But you wouldn't have known that then, and it could have looked like there was going to be a crossover. I mean, that blue and that black line touched right there, 2009. So it would have been pretty iffy. Probably looking at a smaller scale in the month, you can have maybe saved yourself some time and money getting out on a day chart there. So let's make this comparison though from gold to Nugget now. So as far as my take on ETFs right now, there's larger leverage portfolios, there's smaller leverage portfolios, there's 3 times, 2 times, juniors, inverses. You can find what you're looking for, and if what you're finding or what you're looking for isn't up, you can find the inverse of it, and that's up, and just stick to what you like. That was a big lesson through this research. So I've got Nugget on the left, gold in just general on the right. Gold's gone nothing but up over time. What's happened to Nugget? It's gone nothing but down over time. So I'm trying to think, what does this mean? The price of gold is going up. Why? Because either the demand is going up or the supply is going down. What does this signal? This is a miners company and it's going down. Sounds like they're doing less work. Sounds like they're becoming less profitable, or maybe not less profitable, but equally profitable for less work. I don't know if this is accurate, but to me, what this looks like is, even though Nugget is a bullish portfolio, it should be going up. It's only gone down. It looks like they're trying, or I say they, I don't know who's they. It looks like the gold market is forcing scarcity to increase the cost. And then these little news events of, oh, we're going trade war, blah, 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 that get those blips in the gold and you can make your money along the way. But why wouldn't you work less if you knew less of your product meant the price would go up? You got to find that balance. But yeah, that's my thoughts on it so far. Like I said, I looked into this the other night and it just got late. There's a lot of cool information to know here. But I've been trading nothing but Nugget and Dust recently, and I also have a bit of gold. So where I'm at, I'm going to keep my eye on them. I think I know how they trade now. I like to keep trading them. As far as my physical gold, might have to go sell that. But I think that's a good point to end the episode on. As always, thank y'all for watching, and see you next time.